Okay, well, welcome everyone. It's now 4 o'clock, so I think we'll kick off. Thanks for those that have already come in early, and I know we had a full house registered for today, which I guess is a quite topical conversation of transfer pricing methods, which seems to be, I guess you could nearly say an oldie but a goodie, and we do often see a lot of issues and challenges coming up with transfer pricing methods, especially for those who are not dealing in transfer pricing on a day-to-day basis, such as ourselves. So we will be putting this recording up. I know that there were a few, because our, I guess our subscription is for 100 users, and so there was a few people that contacted that missed out. So we will be having the video going up live again and emailed out as well. So welcome, and we'll get started. Thanks everyone for coming on. Just a bit about transfer pricing solutions for those who haven't worked with this in the past before. So we are specialised in providing transfer pricing services. We really aim to be as practical, proactive and cost effective as we can. We know it's a complicated area, and we really actually quite enjoy taking what is a complicated area and putting it into easy to understand, or putting into English, as we like to say, as well. You know, with our experience from all the various industries and companies that we deal with. Just looking at our group structure and our operations. Started based here in Australia. It's kind of ironic that I'm actually doing this from my home office at home. I started transfer pricing solutions from my home office at home, what is going to be 15 years ago in March next year. We expanded out into Singapore, and we have my business partner Adriana, who was working for me for many years in Australia, and she's been based in Singapore now. I think it must be getting on 5-6 years at this point. And then more recently, in the last just over 2 years, we expanded further into Malaysia, and that's just been based on, you could nearly say, the demands of our clients. We do operate globally. We have a lot in the US and also in Europe, but we have offices here in the region, so we can work very closely with our clients in these areas. A bit about our recognition. We have won a number of awards for our technical expertise. I'm also on the Australian Tax Office's Board of Tax Advisory panel as well, and we're really pleased, and it's just been announced last week again, that we are a Tier 2 transfer pricing advisor in Australia and in Singapore. So we're really rapt to be put up there at a Tier 2 with a lot of other very good firms at that level as well. So today, so my name is Shannon Smith. I'll be presenting with two of my colleagues as well, Kevin and HC. Kevin and HC, also based here in Australia with us, have both over 10 years experience themselves in transfer pricing, and we have a lot of experience in various different industries, company types, and also a lot of the different types of transfer pricing transactions. And once we're looking at transfer pricing transactions, we, when we're going through that process of looking at what is it, identifying the transaction and working out what is it that we're actually looking to price, well, now we need to work out how are we going to price it. And we can't immediately jump into what we call the economic analysis and getting the numbers. We need to work out a method as to how are we going to price this. We have a transaction between international related parties. We've identified the transaction. It could be a debt. It could be a distribution function. So we've got a buy-sell distribution. It could be a service transaction. Now we want to work out, well, how are we going to price it? And we need to have a look at the transfer pricing methods. Now, one thing that's interesting around transfer pricing methods, if I speak with a management accountant, they do get really excited when I talk about transfer pricing methods. They're like, I totally understand everything about transfer pricing methods. And then I start talking a bit about the tax side, and then they realize actually there's two different types of transfer pricing methods. There's transfer pricing that you may do internally within the company, which again is still similar to what we're doing from a tax perspective, but they're doing it from a management transfer pricing perspective. Now, ultimately, you should end up with the same outcome, but sometimes it might be due to your IT systems or different other challenges within the business that we may implement the transfer pricing in a certain way and then test it from a tax transfer pricing perspective. So what are some of these transfer pricing methods that we're looking at from a tax perspective? And this is important. This is and we'll go through the different types of methods. But, these methods are under the OECD guidelines. They're adopted under our Australian transfer pricing rules, and the same in Singapore and Malaysia. So we actually have the traditional transfer pricing methods. So the traditional transfer pricing methods is the comparable uncontrolled price method. So that's the CUP method, the resale price method, the cost plus price method, and then we have transactional profit methods. So we have the traditional methods and then transactional profit methods. So we have the profit split method, the transactional net margin method, and potentially we may have some other methods. And the reason for that is ultimately we do need to get an answer for every transfer pricing problem. There needs to be a price somehow that we're going to come up with. And on some occasions, we may actually have to look at another method because we weren't able to apply one of these five main arm's length transfer pricing methods. So sometimes we might be looking at that other method, or we might even look at a combination of the different methods as well. So when we're looking at the selection of the method, and we'll shortly go through what are each of the types of methods, we need to actually think about what is going to be the most appropriate method for that particular transaction. So we need to consider, is it a traditional method? Is that going to be the most appropriate? Or maybe the profit method? What is the transaction that we're looking at? Where possible, the traditional methods are preferred, but we don't always have the economic data to be able to implement those. Now, the ATO says that they actually, and these are the internationally accepted methods, but the ATO and the Australian transfer pricing rules, they don't really prescribe a particular method or preference as to how you actually arrive at your arm's length outcome, but you actually should choose the method that is best suited for your circumstances. So sometimes when we'll be working with clients, we'll have in our mind, okay, this is the particular transaction, this is the method we're most likely going to use and apply. And then we might start going through that process with the company. We understand the industry, we understand the business of what they're doing. And we actually might identify that actually this method isn't the most appropriate or going to be the best method for that particular situation. So we may change the method. Now, it's really important in selecting the transfer pricing method that you actually get it right and you really consider the other alternatives available to you so that you don't have a situation where you select a transfer pricing method and then you move to the next stage, which is when you do the economic analysis. So you really get into the numbers. And to have a tax authority come in at that stage and actually disagree with your method. Now, the reason for that is if they disagree with your method and they actually say, no, you should have applied a different method, then all of that economic analysis has been for nothing. It's actually of no use at that point. So I really never want to have an argument with the tax authority on the method. I want to have an intellectual discussion with them on it at the economic analysis. So when you're going through the method, I go through the 5 key transfer pricing methods, and I look at the strengths and weaknesses of each of the methods for that particular transaction. And can I apply that method? What would be the outcome? Why would I apply it? Why would I not apply it? And there may be reasons. Maybe there's a method that is the best method, but I can't get the financial data to be able to support it. So then I can't apply that method. So I've got to consider the nature of the transaction, the degree of comparability, and the availability of reliable data. And unfortunately, sometimes this availability of reliable data does start to push us down to which method we might be looking at. But this is a really important part of the process. Now, if I speak about history, I guess you can say history lesson, but I used to work in the US. In the US, they are very focused on the selection of the method. Now, I've been back in Australia 15 plus years, but so it was a bit of a while ago, but they are very focused on the selection of the method. And we would write, you could say pages and analysis on the selection of the method. At that time, I returned to Australia and I would be told by a lot of advisors, and I was working in the Big Four then, oh, no, it's always going to be this method. We're always going to use the TNMM. Don't even worry about it. Just write one line. We selected the TNMM and let's start performing the benchmarking. Now, that's all changed. Those days are gone now because of the new transfer pricing legislation that came into place back in 2013. That's all gone now because of the processes we need to go through in that. Now people are actually going through and looking at the strengths and the weaknesses of each of those methods. And that's really important to make sure that you get the facts around that. So looking at the comparability analysis, what do we mean by comparability? Well, at a very high level, what we're trying to do is look at the transaction that you have between related party transactions and identify a transaction or a way in which to price that that is comparable, that is with unrelated parties. So what I'm trying to do is, how do I price red apples and green apples? Does it make any difference that they're different colors, or am I just trying to price apples, and actually whether there's colors or not doesn't make any difference? So you're starting to look at really the comparability factors. And again, this is something that when I look at the methods and I do my little table, and I like to make sure I've got the strengths and weaknesses and go through that. I love another good table when I go through comparability. It's really important that you actually go through each of the different looking at the methods and looking at the transactions from the comparability. So thinking about what are the characteristics of the property or the service that you're trying to look at. Is that similar to the related party transactions or the unrelated? And are there any differences that would make a material impact from an ultimately financial? What are the functions performed, the assets utilized, and the risks assumed? So what are those that you've got between the different parties? What about contractual terms? And that's why sometimes now it's even more important. We're getting lawyers involved a lot with transfer pricing. We're getting it going into the courts and litigation involved. All of a sudden they care about these legal agreements. So what have we got in your contractual terms? What are some of the business strategies that maybe your related party is doing that others might not be doing? What are others doing that you might not be doing? And what are the economic circumstances around it, around the transaction for the related and unrelated? Maybe it's geographic. More recently, if you use an example, economic circumstances. Look at the government support we had here in Australia and many other countries as we all went through COVID. They're different things that you need to think about, you might need to look at and consider when you're going through it. So let's get started in going through, well, what are some of these different transfer pricing methods, these arm's length pricing methods? So I'll hand you over to HC to start off.
Thanks, Shannon, for the introduction. All right, I guess the first one is comparable uncontrolled price methods. We call it the CUP method. As the name suggests, it is a comparison of a price between your uncontrolled transaction, meaning uncontrolled, meaning third-party pricing, against that of your related party pricing, right? Shannon, you might have to click.
Oh, sorry.
Yeah, no problem. As Shannon has mentioned earlier, historically there was a hierarchy amongst the 5 methods in the OECD TP guidelines. So at that point in time, the traditional transaction methods were actually preferred as compared to the transactional profit methods, which Kevin will go through later. But the OECD has since changed from the hierarchy approach to the most appropriate approach, where each method will have its own merits when you're selecting or selection of methods during the selection process. Now, the key difference between the CUP method and the other 2 traditional methods, resale price and cost plus, is that CUP method compares the actual price of the products or services, while the resale price and cost plus compare the gross margin of the products or services. Right, CUP can also be used for your intercompany loans transaction as well. There are of all methods, there are always pros and cons for each method. And for CUP, you have to go through comparability factors, particularly the products or services characteristics where the products need to be more or less identical. Shannon has given an example of your red and blue green apples. Again, an example where you have a blue car versus a red car, which may actually not be identical, though it is a car of the same model, but the color itself may impact the pricing, right? It may be due to raw material sourced during the process, where it may be different for your blue car and a red car, right? So that may impact the pricing as whole. And on top of the characteristics, you have to have similar contractual terms, such as your freight arrangements, your volume, and your discounts, some of which can be adjusted to increase the comparability. And lastly would be your economic and market conditions, where different geographic locations may have different pricing, right? Cars sold in Australia versus cars sold in US obviously will have different type of pricing altogether. Though the cup method may present a more direct comparison, but it is very difficult to apply due to the high comparability requirements. Right. Let's illustrate this in a scenario on the next slide so that we can see what I'm saying here. So here we are showing a simple scenario for cup to be applied both externally and internally. On the internal scenario on the top part, you have company A selling products to both a related party and third party. Right here you have internal data, which is the price sold to company B that can be used as an internal cup against your price sold to company C or related party. So this is what I mean by direct comparison, where you are actually comparing apples to apples to assess the pricing between the two, to make sure whether it's at arm's length or not. Now, what happens when you do not have internal data, right? This happens only if the data can be reliably obtained and applied, and only then you can actually use the external data between two independent parties that is directly comparable to the products that you sell, and benchmark your external price against the price sold to your related party. Right, a common circumstances on this nature is commodities, where you most likely have publicly available pricing for you to actually utilize and compare the pricing that you sold to your related party, right? So that's as a whole, that's your cup method. Next, I'm going to go through the next method, which is the resale price method, right? So resale price method, in comparison with cup, it generally focuses more on the functional analysis profile rather than your product comparability. Shannon, if you could go to the next slide as well. So the resale price method is used for distributors, where we are comparing the gross margin of the products sold, and it is actually most appropriate when there is no substantial value added to the products by the reseller. What I meant is that the reseller is merely reselling to products without any modification, right? No additional packaging or processing that that modifies what you have purchased in the beginning, right? Or simply saying the reseller does not contribute significantly to the value creation within your supply chain, right? So in layman terms, they buy and they sell to a third party related party. Hence, where the related and independent party transactions are comparable in all aspects except the product. Generally speaking, the resale price method may be more reliable than the cup method. Well, having said that, with the COVID pandemic in place, now it has, the comparability will be more restrictive, and we are now separated into two broad categories, right? One is the industries that are impacted by COVID, and those that are benefited by COVID, healthcare industry that benefited more from COVID, for example. And well, nonetheless, the more comparable the product, the more likely the resale price method will produce a better result, obviously. If you compare it against just solely relying on the functional analysis profile, right? Let's look at the example on the next slide to see how we could apply the resale price method. Now, the goal of the resale price method is to test the resale price margin of the reseller. In this example, we can see that the related party reseller buys from a related party supplier at $85 and sells at $100, earning a resale margin of 15%. Right, this is on a gross level. Now, the goal is to test this 15% resale margin earned And this test can be done with internal or external comparative data. Internal resale price margin can be used if the reseller buys from a third-party suppliers, and we can then compare the margin earned that was sold to the real party on the gross level pricing. And if internal data is actually not available, external data can be obtained through a benchmarking study, but there's a constraint, only when the data is reliable, right? I guess the constraint here is the reliability of the external data due to the difference in your accounting classification, right? So in the financials, the accounting classification of the companies in terms of the expense item may differ company by company, right? Some companies may have classified certain expense item in their cost of goods sold, but some may have classified that same expense item in the operating expenses, right? So which means that results in a different margins, right? So you're actually not comparing, the comparability between the two are not accurate, because you have one that has expense item in the operating level which did not affect the gross margin level, while the other would have the expense item on top at the cost margin, cost of goods sold, and which have impacted that margin, which means that you have like a different margin altogether, right? That's the constraint that you may have if you actually use the external data for resale price method, right? So next will be your cost plus. Cost plus method, I think very similar to resale price actually, but just for different functions. So for cost plus, I think I'll go to the next slide as well, Shannon. Thank you. Cost plus, same thing. We compare at the gross level, where you analyze your gross markup and cost base for both related party and independent party transactions, right? As you know, in cost plus, direct and indirect costs of producing that good or providing a service are normally used to compute the overall cost base, right, in your cost of goods sold. But such costs are limited to the costs of the supply of goods and services, and should take into account an analysis of the supplier's function analysis, right? The cost plus is generally used for, those companies that are cost driven, right? For example, semi-finished goods sold, manufacturers, joint facilities for long-term buy and sell with long-term buy and sell arrangements, some contractors, and as well as obviously the service providers that are also cost driven, right? So if you compare cost plus, resale price, and CUP, basically it's just CUP, and then resale price and cost plus will be determined by the different functions of your company, right? So both resale price and cost plus is generally the same, except for the formula used to calculate your cost plus PLI, right? In the next slide, I'll just go through example similar to the resale plus resale price, where you see here, company A is actually a contract manufacturer of spare parts, right? It sells to related parties, company B and C, and for company A earns actually 42% cost plus margin from the company B, and then the goal is to actually test the cost plus margin that earned from company C, which is the 42%. Similar to the resale price margin, it can be tested internally or externally, where internal, you're using internal data, but if you're using external data, the same constraint will apply as well, right? So if you use an external data approach, the classification of expense item, you have to make sure that the classification of the expense item are similar both to your tested party, which is your company, versus the respective comparable companies, right? It's not just comparable companies alone. You have to make sure that all are in line in terms of classification of expense items, so that when you actually compare the same margin accordingly, to make sure that you are actually within that arm's length principle, right? So I guess that's this actually concludes the traditional transaction method where we have cup, resale price, and cost plus methods. And now I guess I will pass it on to Kevin to go through the transactional profit methods.
All right, thanks, Hong Chuan. Now we are going into the transactional profit methods. What is the key difference between these two methods, the transactional profit and the traditional methods? If you look at traditional methods, it aims to test the pricing of the transaction and determine whether or not your related party dealings is arm's length. So if you think about it on another way, it's almost like your top-down approach. You test the transaction first. Whereas the transactional profit method, you are actually testing your profit outcome that you get from your related party dealings. So it's almost like your bottom-up approach. So it's almost the traditional approach is a top-down, and the transactional profit is a bottom-up. Okay, so when do you usually use transactional profit methods? Generally, you use it when you can't apply the traditional method. Simply because, when you look at traditional method, it requires a high level of comparability, but it also gives you a very direct testing. So the more direct testing you can do, the better outcome or more reliable the analysis become. In the perfect world, where you have all the information available to you, then you go for traditional method. Okay, but in practice, you usually don't get that much information publicly available. That's where the transactional profit method can be your alternative. Or it can be when you have circumstances where your company is involved in a product or services that are very unique or context very unique intangible properties. Again, this means that there is literally no third-party information available for you to make comparison in. So then again, transactional profit method will be a more or your best alternative. Or you can be you can have a business model that has such a complex or complicated supply chain where you have multiple entities that are contributing valuable intangibles to the transactions or through the product that you can't really split them up and test it independently. Then again, transactional profit method will be suitable. Now, Shannon has touched on this a little bit earlier. Transactional profit method, you have two methods. You have the profit split methods, and you have the, I guess this is, you might be more familiar with this. This is a TNMM method, the transactional net margin method. Now let's go into the profit split. What is the profit split method? As the name suggests, this method aims to come up with a way to split your profit in an to achieve a best arm's length outcome, to split your profit in a transaction similar to what a third party or independent party would do if they're working together. Take, for example, you have two independent parties that comes together to in a project to service a customer. Both companies have provided or bring together their IP, their know-how, their specialty to the projects. How would they then split the profit earned in this project among each other? So this is what the profit split method aims to achieve. Because of the structure of this method, it only applies in a very specific situation. Usually you will have a highly integrated transactions where you have parties making unique and valuable contribution, usually in the form of unique intangible properties. And each of these parties has take a share of the economic risk associated with the projects. Now, because of this specific circumstances that makes the profit splits applicable, you don't always see that in the transfer pricing study. So it's very rarely used. But just to give you an example of how this could be applied, there are generally two common approaches that you can apply this profit split. First one will be the residual analysis, A second one will be what we call a contribution analysis. Sometimes you can use a combination of both, and both approaches have can be very complex and time consuming, but on a conceptual level, we'll go through that in an example just to tell you, conceptualize how this can be applied. Let's start with the residual analysis. Now, take this for example, you would have two entities within your group that want to come together to develop a product. Each entity has some expertise, have some very high skilled employees sitting in the entities that is driving the project. They are developing the products and they want to market and sell this product globally. At the same time, they will have a group of subsidiaries that provide them with support functions. This could be, for example, you have an entity doing a contract R&D activities. They do the R&D based on your instruction or your core, we call it core entrepreneur instructions. You have a procurement agent that acquire raw materials for you to manufacture these products. You have contract manufacturer in the chain that manufactures the products for you. You have a limited distribution entity that help you distribute these products to the global market. And obviously you have after sales entities which handles your core service, anything related to after sales services. Now, when you look at the residual analysis, what do you do first? Usually the first step is to identify how much you need to pay all these entities in blue. We call it the routine functions. How do you do that? You look at the sales you generated for the products during the year. Let's say, for example, you develop the product, you manufacture it, you sold it to the global market, you achieve a $1 million sales. How much you need to pay them? It depends on usually a cost plus arrangement because they are very limited risk. They should be guaranteed a profit. That's why we go with the cost plus. So after paying them, you spend 500,000 in expenses. Okay, so now you have 500,000 left as a residual profit. Now, where this then profit split method, take this 500,000 and look or split it between you and your core entrepreneur. How do you do it? You usually come up with a contribution analysis, which we will discuss later on, and to determine how much should be allocated to you or your core entrepreneur, depending on the value you bring to the project. Okay, so that is the residual analysis. Now we go into the contribution analysis, which is the second approach. This is almost identical to the first one, with the exception that you do not have routine service provider in your chain. So you have, and it is very common if you are in a business of providing services, you have a few companies coming together with very highly skilled employees providing very specialized knowledge. Each contributed valuable IP to the projects. You don't have routine support entities, so you just split the profit, the overall profit, meaning your $1 million sales among the entities that are involved. And this again will go through a contribution analysis. What this does is basically trying to weigh each entity's contribution to the project, and then you allocate accordingly. This is sometimes contribution analysis is quite subjective, so it's usually a very complicated area, and it requires a lot of time and effort and a lot of substantiation to support your allocation, because this is based on management judgment on the value you bring to the project. Okay, so on an overall basis, that is what a profit split looks like. Now let's go into the more commonly the method that you would have seen in your transfer pricing documentation, which is the transactional net margin method, or the TNMM. In practice, this is, I would say, the most commonly used method in the TP transfer pricing world, simply because it is more flexible than the traditional method. It requires less level of comparability. What it does is basically, as the name suggests, it look at the net margin or profitability of the company based on your, the related party dealings. Okay, it can be applied in 3 different methods. Shannon, I think it's the next slide. You went one behind. Forward. Yeah. So yeah, you can do it in 3 general ways. You can do it as a single transaction basis. What this means is, or this is more suitable for companies that do not have a large volume of transaction during the year with the related parties. Take for example, if you are commodity traders, you have only 2 to 3 but very large trades with your related party dealings, then you can sort of work out your profitability of every single trades during the year and see whether or not they are arm's length. And we will talk about how do you prove that it's arm's length later on. And then secondly, you have the aggregation of transactions. This is suitable where you are able to group the related party tradings in categories, and your internal accounting systems allows you to track your profitability based on this category as well. Take for example, if you are a distributor that distribute only 2 types of products, very different products during the year, we call it product A and B. Product A, you source solely from third party and you sell to your third party customer. Product B, you source solely from related party and you sell to your third party customer. If your accounting systems allows you or give you the ability to track your net profit for product B, then you can just, I will just test my product B as a whole. And then the next one is your whole of entity basis. This is basically testing your profitability of the whole company for the entire year. You might think, what is the difference between this and the aggregation of transaction? Whole of entity is basically more suitable where majority of your sales or your cost is related to your related party dealings. For example, you buy 90 to 100% of your products from related party and you sell these products to third party. So your entire financial performance is relying on the related party transactions or impacted by the related party transaction. Okay, so now we have talked about profitability. Look at profitability, net profit level. What does this? How do we do it under the TNMM, right? We use what you call the profit level indicator or the PLI. There are many PLIs under the TNMM, each for different circumstances, but some of the more commonly used one will be like your operating margin. That is your EBIT, earning before interest and tax over sales. And this is usually used to measure the profitability of a distributor. It basically look at how profitability you are on the sales that you bring in. And then you have the full cost plus markup, or in another term, we usually call it the net cost plus because this is a net profit over cost. Basically, is used to evaluate the profitability of service providers or manufacturer because they are more into cost. So it looks at net profit over your total cost, your cost of goods sold, and your operating costs. And then obviously you have the less common methods, PLI, which is your return of asset and barrier ratio. Now, similar to all other methods, we'll give you an example on how, in general, TNMM method can be applied. We go to the next slide. Let's say, for example, you have company A based in Singapore, which is your head office. They are into production and manufacturing of organic beauty products. They have, and then they establish a subsidiary in Malaysia that distribute these products to the Malaysian market. Company B, which is the Malaysia distributor, buys 100% of the products from company A. So when you do the TNM analysis, what approach do you use? Do you use the single transaction method? Do you use the aggregation of transaction, or do you use the whole of entity? Now, the answer here would be the whole of entity, because 100% of their purchases, they are from Singapore. So we can say that the entire P&L or profitability of the company is impacted by the purchases from the head office. Okay, so how do we work out the profitability of the company? We look at the sales and we look at operating profit. So for the 2020 year, they have a $10 million of sales. And after deducting all the expenses, they have EBIT or operating profit of 500,000. You take 500,000 divided by 10 million, you get 5% operating margin. Now this 5% operating margin on itself, it doesn't tell you whether or not the transaction is arm's length. You need the second step, which is your benchmarking analysis. What this means is we go into the market, we try to look for distributors of similar products in the similar industry, so distributor of organic products in Malaysia, and work out how much they are earning operating margin wise. If on average they are earning around 5% as well, then we can say that although we don't know what pricing policy they use on the products they sell to Malaysia company or the company B, but we know as a result of these sales, I'm still able to earn operating margin or operating profit similar to what a third party distributor is earning. Therefore, my purchases has to be arm's length. Otherwise, I will not achieve the arm's length outcome. So this is where it's different, like I said earlier, different from the traditional method. You use the profit outcome to determine whether or not your pricing is arm's length, rather than testing the pricing itself. So that concludes the transactional profit methods. Maybe, yep.
Yeah, and maybe so just some of the key takeaways on this, and actually one key takeaway, I have to say, I actually think as much as it's a complex method to use, using the residual profit split method with the contribution analysis, really, when you've got a situation with entities cross-border working together, it is a great method, even though it is a lot more complicated to actually prepare. But it's actually been one that when we've had to have ATO scrutiny, it's one that you've actually got so much detail on it. It's been really good. But the traditional transactional methods are generally preferred, as as the team just talked about, looking at it because you're looking at that on a gross margin basis. So that's why that's more preferred than looking on the profit methods, where you're actually looking at, you couldn't pinpoint it to the exact transaction. So you're looking at it as an overall on a profit-based method. So that's the traditional transactional are often preferred, but as HC said earlier, it's now more on equal weighting. The methods are more on equal weighting, whereas traditionally there was actually an absolute preference, and you would consider first before you actually looked at the profit areas. It's really important to discuss the strengths and weaknesses of each TP method to justify the selection of the appropriate method, remembering that any tax authority is going to come in 2-3 years after the fact, and you need to be able to build your case and tell your story as to why you didn't use a particular method, because the tax authority might come in and say, well, why did you actually not use the cost plus method? Now, thinking of cost plus method, this is one that people do get confused at. The cost plus method on a transactional level, so on a gross margin level, versus the net cost plus on a TNMM, on a net margin level. Why didn't you use it at the gross margin? You need to make sure you put in the reasons why you may not have selected that and instead went for the TNMM. So that's really important. Changing your transfer pricing method, it can potentially, because of the information that you need to put in the tax returns, etc., it can kind of trigger potentially an audit or maybe a review from a tax authority to understand why. And also they have their ideas on certain methods. So if the methods don't align with what their expectations might be, it's also recommended that if the TP method applied remains unchanged, unless there's substantial change in the business, you might need to, but there's no reason why you should be changing it unless when you're analysing the method each year and you actually find one year, while something was the best method, you didn't have the financial data available to you and now you do, maybe that would be, but otherwise try and keep it the same. And then certain transactions need to be tested most of the time with a particular method. As I said, that, loans or potentially resellers, loans using the CUP method, resellers using the resale price. And then keep in mind, there is that tension between the profit outcome versus the price testing. You know, so ultimately the tax authorities say, oh, okay, well, happy with the transactional methods and we have it, the price testing and looking there, but they're like, but we still want you to be profitable. Within this COVID world, this is the challenge we're actually seeing. We saw it in the GFC, we saw it a number of years before that, where, you know, some businesses may not have had the volume transactions to actually enable the gross margin profit, which meant on a net margin basis. So maybe their arm's length pricing at the gross margin was correct. They just didn't have the volume to ensure that the bottom line became a profit as well. So we'll open it up now to any questions that we may, that anyone may have coming through. I actually don't see any questions that have come through our normal question channel, which is unusual. Do we have any questions at all? Any questions? No, I can come back to that if a question pops in. So at Transfer Pricing Solutions, how we can help with any of your transfer pricing matters. We obviously work directly with companies. We also support a lot of accounting firms and law practices to be able to actually provide and support their clients as well, whether it be transfer pricing documentation, master file, local transfer pricing documentation, regional. We do have the global databases, so we can actually cover all different areas from a global, regional and local benchmarking, transfer pricing contracts, planning. So we can kind of do the full suite of transfer pricing services. Now we've got just two or one, thank you. Yes, thank you for the thanks. And the other one, which transfer pricing method, what TPM would the ATO prefer? How is the cut preference in Australia? So yeah, so I guess actually originally we often used to call the cup method the Trump, you know, it was like having the Trump card, but then when Trump became president, it didn't seem relevant anymore or appropriate, because a cup method often is what you're looking at, comparable uncontrolled price. It may be an internal cup or an external cup. So an external cup means we have two independent parties that are actually dealing with each other. So two independent parties dealing with each other. An internal cup is where we have, where it's the business that we're looking at is actually then dealing with a third party. So maybe it's a similar transaction. So the ATO doesn't have, in a sense, a preference. They want the best method for the transaction. When we're dealing with, you know, say debt pricing, we fall into, say, the cup method. There may be other transactions that you may fall into it, but it actually comes down to the best method. And that's why it's really important to make sure you've documented why you selected a certain method, why you didn't select another method. And so we often go through that with each of the methods to kind of go through that.
Yeah, I mean, sorry. Yeah, to add to that, I mean, the cup method, because the nature of that method, you test, you know, you make a comparison between almost like an apple to apple. If information is really available for you to do that, is always the preferred method, right? Because it gives you a very clear reference to what the market is charging right now. So if you're able to prove that and you have the data to prove that, it sort of trumps over the other TP methods.
Yeah, actually, I just want to say, similar to the key takeaways that Shannon has mentioned earlier, you know, the profit outcome versus the price testing, right? So basically, first you need to know, okay, you have used a cut method, you have gone through your comparability analysis, and make sure that your cut method is appropriate to use. But at the same time, sometimes you need to relook at your net outcome, right? Sometimes when you're loss-making position, I would think that it'd be prudent for you to also go through or substantiate why, you know, and on an operating expense level, why is it a loss position, even if you have deemed that you have used that cut method, and the ATO might go to your net level and ask you more questions relating to that, right? So it's prudent to cover both bases. Yeah.
Can you explain a little bit about local transfer pricing documentation? So what we mean by local transfer pricing documentation is often we call it the 80-20 rule, as far as you might prepare transfer pricing. If you have an Australian multinational, you might prepare global group transfer pricing documentation here in Australia that may cover all the transactions that are within the group. However, you may need local transfer pricing documentation in, say, Singapore or in New Zealand, even in an instance where we might have, say, a US multinational, we need local documentation here in Australia, we can't use the US transfer pricing documentation. Local means we look at, well, what is it that they're doing here in Australia? What are the transactions? And getting it down to make sure it actually covers and explains what's going on here locally, rather than America saying what's going on here in Australia and not having all the facts. So it's kind of having a tailored approach. Would a hub and spoke approach be acceptable as a T&MM pricing method in Australia? I'm not sure what you mean by the hub and spoke.
Kevin.
Yeah, quite new to this term, so I'm not sure.
Yeah, I'm not sure. Sorry, if you can add another comment on that one, that would be great. Just as to what you mean as to link it as a method. How often do you recommend reviewing the methods? Balance between set and forget and continual monitoring year on year with trigger for ATO review if to change. So yeah, I guess the method, transfer pricing method, ideally you wouldn't be changing your method you know, each and every year, but as far as documentation is concerned, I guess this set and forget and continual monitoring, you are technically required to be able to be able to support your arm's length dealing. So you should be doing this each year. For some clients, cost benefit wise, they may choose to not do this every single year. And what you're doing then, I guess the risk or the potential risk is, if the ATO came in, would they agree with the pricing you had for that year? You may have checked it all in the prior year, not for this year. If nothing much has changed, maybe you're comfortable that risk would be low. But what you're trying to do with documentation is be able to put something in place that you've tested your transfer pricing. Now, when you do lodge your tax return, the public officer is signing off that the transfer pricing has been reviewed and is correct. So you're actually doing it on self-assessment. Pre-2013, you weren't. So that has changed a lot of clients to make sure they're more updating their transfer pricing. Okay. Now, we've got a number of questions. In case ATO disagree with the selected transfer pricing method of the taxpayer, will the ATO propose another transfer pricing method? Yes, and they'll probably come with another number as well, with an economic analysis. And that may have you in a situation of, I don't know if scrambling's the right word on that one, but Kevin, have you had some of that kind of case? Have you had them?
Yeah, well, as often, yeah, the ATO can always disagree with your method, but they have to provide the reason or justification why they disagree. And they always often, if they disagree with your method, they will come up with their own method.
Yeah.
Basically, usually it's because it's more favorable to them, and they also have to justify why their method is more appropriate than your method. Even in certain cases that you can both have the same method but different results. Yeah, so that is part of, you know, the dispute, the audit dispute that you will go through if you get audited.
Yeah.
Because
so
just
local,
sorry,
you go.
Yeah, because just bear in mind, if it's an audit, they will never come to you with the same results as you have.
Yeah.
Otherwise, there won't be an audit.
Yeah.
It's always come up with they will always come to you with a different result, and that's why they are trying to prove their result, their analysis is better than you, and you are trying to prove yours better than them, and it goes on.
Yeah. Tug and war, isn't it?
Yeah.
If a local family trust borrows money from overseas relatives, do we need transfer pricing documents? If you have interest being charged, and it's so therefore it is an international related party transaction, and you've got interest being charged, then the interest being charged, if you're claiming tax deduction here in Australia, it needs to have documentation. Now we did get, we got the hub and spoke, and now I understand. Okay, centralized IP as a major head office hub with some value contributions for local agencies. The T&MM, you know, if you've got IP central and there is some value contributions for the local agencies, I would be heading towards more the residual profit split or in that instance. I think that because unless if the local agencies are performing something that we can say is a routine return, so they're providing support services, it's what you would get if you engaged an independent party to provide those same services, then they can be tested on a TNMM method, and then just I guess by default, the profit all ends up back in the centralized spot. Each of the local agencies are rewarded from an arm's length perspective on a TNMM for the services being provided. And if that value contributions is related to the service you're expecting them to provide, that would be okay. But if there was extra value being done in that local country, so in Australia, they own the IP, New Zealand has their team, they're giving support to the New Zealand clients, but also the New Zealand team comes up with other ideas that then Australia says, hey, that's great, I might take those ideas and use them in Singapore. All of a sudden you've got this cross-border situation that you need to think about. Yeah, so that's good. Okay, now we have a lot. Netflix, you've probably seen everything by now on Netflix, and I know probably people need a little bit more, but we do keep recordings all of our webinars. We have quite a lot of content, so if you like and subscribe our YouTube channel, you will get alerted so that you'll never have nothing to watch on Netflix. You can just screen that on. Now, the other thing that's going to be coming back, hopefully in this post-COVID world, is we will be going back to doing our Transfer Pricing 101 workshops. These are targeted at finance and tax managers and accounting firms, usually a one-day event. We're going to do them Melbourne, Sydney, Brisbane and Adelaide. So we will send you out a survey to see what people are thinking. We might we'll do the online as well, and we will do some, I'm a big fan of face-to-face, but you know, and it can be quite interactive for those. So now that hopefully we can all travel, we'll be having those next year, and we'll just try and gauge interest and see what demand we have in the different locations. And if we have enough demand in each location, we will go out there. But thanks very much for joining us today. I hope you found that useful. If there's any other questions that come up later, feel free to reach out, and we look forward to working with you in the future. Thanks very much.
All right. Thanks, guys.
Thanks, everyone.
Thank you.